I'm not a financial advisor. This is not financial advice. Please do your own research. Welcome to the VinnyGMarkets channel, brought to you by Vinny G Money. We have a lot to go over this video. It was a big week for the markets, a lot of price movements, a lot of different news pieces, and we had that Federal Reserve meeting, which was on Wednesday. So let's get right into it. The stock market on Monday down big time. S&P 500 falls 1.7%, Dow sheds 600 points, and we have two different catalysts on why the markets were down big on Monday, and we went over both those situations in the last video. But let's pull up some reasons why we know that the Evergrande Bank situation is not a big situation at all. First off, the People's Bank of China, in response to the Evergrande Bank situation, injects $18.6 billion into the banking system during the Evergrande crisis. China's central bank boosts its gross injection of short-term cash into the financial system after concern over a debt crisis of China Evergrande Group. The People's Bank of China pumped 120 billion yuan, 18.6 billion, into the banking system through reverse repurchase agreements, resulting in a net injection of 90 billion yuan. That matches the amount seen on Friday, and that was just below that of Saturday. Sentiment was also boosted after Evergrande's onshore property unit says it plans to repay interest due Thursday on its local bonds. And we could even look at this chart. We see that China's response is just pump more money into the system, and that's good for the market, which is why we know that this situation is nothing to really monitor at all. And also, Evergrande Bank ranks only 8 in market cap when it comes to China real estate companies. So it's not even one of the biggest real estate companies in China. And the reason why it ranks so low in market cap is because it's been dropping all year, this bank, down 85%, as you can see from this tweet. And since we're not in China, this is hard for us to realize, and we only go off what CNBC and other financial news reports tell us here in the United States. And they promoted nothing but fear when it comes to this situation. But if you really know what was going on, this was a known thing in China, so it's not really a big deal. And again, at the end of the day, China is just pumping more cash into the system. So this is no reason why the market should have been down. So if we look at the stock market on Tuesday, we see that it was flat, slightly in the red. Again, this is all anticipation on the Federal Reserve meeting, on what they're going to say on Wednesday. And when we go to Wednesday, we see that the markets were up big time. Reason being is the investors knew that the Federal Reserve was not going to taper this month. They weren't going to announce any clear path to tapering. But if you pull up the CNBCs, the Bloombergs, Fox Newses of the world, they're going to have articles and reports saying that the Federal Reserve tapering is a done deal. It's going to happen next meeting in November. And this is what they've been saying on and on and on. That next meeting, they're going to taper. They're going to taper. We've already been over this in prior videos. But I'm going to actually pull up clips to show you guys what the Federal Reserve actually said. And what did they say on Wednesday? Again, they were very vague. Jerome Powell, Uncle Jerome, was in that house on Wednesday. He stated that there is no immediate taper, and we're going to pull up these clips right now. So in a nutshell, from those clips, you see that 1, there is no immediate taper that's happening. 2, that they use very vague language as usual, things such as if progress continues. I don't know what progress they're talking about. We'll go over what the economy is actually doing later. Words like may and soon, while no decisions were made. All this is just vague language. They still gave no direct plan to actually tapering. And again, the markets love that because more money is still going to be injected into the system. That money has to go somewhere. Where is that? The stock market. And you also in this video hear them still blaming inflation on bottleneck supply chain issues. I don't even know what bottleneck means. It's just language that they make up to throw people off. But the one thing that you don't hear him say about inflation is that inflation is being caused by all the money printing that's going on. So they keep people looking the other way. But the real investors, the real big money, they know exactly what's going on. And again, that's what we're providing you on this channel. And also in those clips, you hear them mention Delta variant a lot, so you know they still have that in their back pocket to stop any monetary changes going forward. And what we do in real time, because we knew that there was no immediate taper, and also on Wednesday, the 10-year Treasury remained low at 1.3%. We sold a bunch of puts. You'll see the Facebook put, that's money in the bank that expired. We kept the premium, and we still have the JP Morgan and Microsoft puts in play. And what happened to the stock market on Thursday? Stock market up big time, which definitely helps our put positions. Of course, we sold our puts while the market was still somewhat down from Monday. We got a nice cushion on this bounce up on Thursday because we sold them before the market closed Wednesday. So we're sitting good with those. The market Friday was basically flat to a little higher. But let's go over the elephant in the room, which is that US 10-year Treasury. It did go much higher this week starting on Thursday. It went up as much as 1.45%, along with the US dollar, which did go up as much as 93.5%. But with the US 10-year Treasury rising, the US dollar did cool off and did come down lower from the 93.5, but we'll continue to monitor that if the stock market dips because of the 10-year Treasury. But that 10-year Treasury, let's hypothetically say it starts dipping along with the market. If that is what happens, we could take a look at that as the market's going to bounce back up because it's going to like that lower 10-year Treasury. So we'll see what that does. We'll continue monitoring it, and we'll see what the US dollar does. If the US dollar continues to cool off and the 10-year Treasury even remains at these levels, I would still take that as a bullish view. And one of the main reasons why I would anticipate for that to happen is, let's pull up this article from that Federal Reserve meeting. This was also put in place. Fed reverse repo usage hits record high after tweak to limits, so they did raise the limits on this. Demand for the so-called reverse repo has climbed further after the Fed this week boasted the amount that each counterparty can potentially place the facility to 160 billion from 80 billion, so that's double the amount that could be put in. And also from this article, assuming a mid-2022 end to asset purchases means the central bank will still be adding more than 400 billion of liquidity into the financial system. Debt ceiling situation is also fueling pressure, but even if that's resolved quickly, which it most likely will be, pressure from the bill supply imbalances could continue. The cash glut in liquidity markets is not going anywhere anytime soon, and the downward pressure on money market rates should persist over the next 6 to 12 months. Suddenly, a 1.5 trillion of reverse repo usage doesn't appear unreachable, and without these reverse repos, what would happen is these money market funds would probably start charging a negative interest rate, which the Federal Reserve doesn't want because that'll cause a whole new set of problems. But let's take a look at the reverse repos, what they actually did this week. Monday, we see 1.2 trillion. Tuesday, another 1.2 trillion. Wednesday, another 1.2 trillion. Thursday, look at this, we got a 1.3 trillion. And Friday, we end off the week at 1.3 trillion. So we see these rising, and we see stated in the article this should cause downward pressure to the interest rates, including the 10-year Treasury. And as long as this continues to increase, they're using these reverse repos to manipulate that 10-year Treasury down. So right now, we're anticipating that 10-year Treasury to drop. I'm thinking it did spike this week and everything was just off balance due to all the news going on this week with the Evergrande situation and the Federal Reserve meetings. So that might have been causing knee-jerk reactions in these rates. Again, we'll continue to see and monitor what that 10-year Treasury does. We'll see if it drops. If it doesn't drop and continues spiking, we'll assess that situation as it happens, but due to these reverse repos, I find no reason to believe that the 10-year Treasury is going to continue rising. So let's go over some economic news, which I'm sure you already know isn't good. U.S. current account deficit widens to a 14-year high in second quarter. The U.S. current account deficit increased to a 14-year high in second quarter as businesses boosted imports to replenish depleted inventories amid robust consumer spending, which we went over in the last video is most likely from the schools reopening. Let's go to our second article. U.S. business activity grows at slowest pace in 12 months. U.S. business activity expanded at its slowest pace in a year in September amid relentless supply constraints and peak in demand, in line with expectations for a sharp slowdown in economic growth in the third quarter. And we have our weekly jobless claims numbers this week. We have another 351,000 people first-time jobless claims, and that's worse than than expected. So again, with all this bad economic news, how is the Fed going to taper their asset purchases? And when it comes to inflation, Morgan Stanley held some type of conference this week with the CEOs of a bunch of big time companies, and they're all under the consensus that inflation is out of control. And you could see in the conclusion part of this article, corporate executives are clearly aware of those costs and are responding to protect their margins. Many politicians are dismissing them so far, but they'll recognize them when their voters start really complaining. Next year is an election cycle. It will be interesting to see the responses to the complaints arising from increased cost items over the next 12 months. So these CEOs are basically saying that these costs from inflation are going to be passed on to the consumer, and the consumers are going to start complaining to the politicians, and the politicians are going to try to do something. I don't know what they're going to do. There is no stopping inflation until the Federal Reserve stops printing their money. But going over inflation, what do we have? We have crude oil. And crude oil this week up big time. It's around $74. As we pull up our first article, OPEC struggles to pump more oil to meet rising demand. So the global demand for crude oil is rising, but the OPEC members, they're struggling to keep up with their output. Also, Amazon's former security chief is now guarding the Line 3 oil pipeline. You know, in our prior videos, we've been covering this. This still seems to be an ongoing issue, and they still have it in the media that they're now securing this oil pipeline due to protesters. So this could lead to further disruptions in their output. And also, crude prices jump on oil sands outages. Syncrude has cut its production for the month due to mechanical disruptions reported by Bloomberg. And Syncrude, majority owned by Suncor, produces 275,000 BPD of crude oil. So due to their mechanical issues, that's going to cause disruption in the crude oil supply as well. So we should see the price of crude oil to continue to go higher as we continually state on this channel. And if you've been following this channel, we know that the price of crude oil going higher keeps the energy sector up along with the financial sector up, and those two sectors being up brings the overall market up as well. And going into the crypto market this week, we see that cryptos were down. Bitcoin did have a pretty big pullback. I know in the news, everybody's going to claim, and it's being reported, that it's due to the China ban on cryptocurrencies. That's definitely not the case. This narrative has been going on since 2017. Nothing's changed. Just because China's been trying to ban cryptocurrencies doesn't mean that it's happening. They're just finding other ways to get access to it. But because we go over the truth on this channel, which is why I hope everybody's continually tuning in, we know that the pullback happened because the CME contracts, those expired this week. We went over that in our last videos to expect a pullback, especially if Grayscale wasn't purchasing anything, which they weren't this week. They actually sold assets. And if we pull up Tether this week, we see there was a little bit of a pump in Tether, but nothing significant. And you know, if you've been monitoring Tether like we have been on this channel, you see that we've been stuck at that $68 billion mark, and that really hasn't been pushing up. So even though I don't like the overall setup of cryptos going forward, the Federal Reserve, they are still pumping their money, and also we are headed into the beginning of the month next week where Bitcoin is needed as collateral for the new contract. So we'll continue to monitor our indicators, Grayscale, Tether, USDC, and again, any significant news to see if the markets could get pushed up, especially as we go into the beginning of next month. And because on the VinnyGMarkets channel, you know we keep our ear to the streets, so we look for any type of corruption going on. And we see that Bloomberg News pays reporters more if their stories move the markets, you know, because that should be normal standard practice. Also, JP Morgan agrees to pay $15.7 million to settle spoofing lawsuit as they've been accused intentionally manipulating prices of the U.S. Treasury futures and options. If you know the amount of money they were making manipulating these things, you would know that $15 million is a complete joke. And it's not the first time JP Morgan's been caught. We know they've been caught manipulating the precious metals market. And also they've been caught manipulating the foreign exchange market. And you see back in August 5th of this year, they regained their access anyway to those markets. And you actually see that JP Morgan stock responded pretty positive after that $15 million settlement, because the investors know that's a complete joke. And what are you going to do? It actually does help us with the puts that we just sold this week as well. So that's what we do on this channel. We pull up all the corruption. We keep our ear to the street. We corporate hustling. So if you like what you hear, continue to tune in. Hulk smash that like button. And as always, I'll leave you off with this. The God of the Bible, the God of Abraham, the Father of our Lord and Savior Jesus Christ, is real, and may He bless you.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our current pace of asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's guidance. While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. Even after our balance sheet stops expanding, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year. While these supply effects are prominent for now, they will abate, and as they do, inflation is expected to drop back toward our longer-run goal. The median inflation projection from FOMC participants falls from 4.2% this year to 2.2% next year. The process of
Thank you. Thank you, Chair Powell. Well, I had a question about jobs and the Fed's schedule, the Fed's policy framework you laid out here. You and other Fed officials have often talked about expecting a job market pickup in September as more children return to school, freeing up more parents to work, COVID abating. You mentioned in the past the extra unemployment benefits expiring. There's some real-time data suggesting that we may not be seeing much of a return of labor supply. So do you still expect to see that in the next couple of jobs reports? And how would a relatively weak jobs report in September affect your plans? Thank you.
So you're right. We have a really, I'll call it a unique situation where by many measures the labor market is tight, and 11 million job openings, very widespread reports from employers all over the economy saying it's quite difficult to hire people, wages moving up and that kind of, so quite a tight labor market. So our view, I think a widespread view a few months ago, was that several things were coming together in the fall, including kids back to school, which would lighten caregiving duties, including the expiration of extra unemployment benefits, and other things would come together to provide an increase in labor supply, and so we'd get out of this strange world where there are lots of unemployed people and a high unemployment rate, but a labor shortage. And so what happened was Delta happened, and you have this very sharp spike in Delta cases, and I think so that affects, for example, when schools are open 60% of the time, or when they're always at a threat of being closed because of Delta, the Delta variant. You might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that. So some of that may not have happened. Also, people didn't, as you know, hiring and spending in these face-to-face service industries, travel and leisure, it just kind of stopped during those months. So that really the big shortfall in labor in jobs was largely in travel and leisure, and that's clearly because of Delta. So that all happened. And so what we know is that it didn't happen. I think there's still, it may just be that it's going to take more time, but it still seems that inexorably these are people who were largely working back in February of 2020. They'll get back to work when it's time to do that. It just may take longer time. You're right, though, it didn't happen with any force in September, and a lot of that was Delta. In terms of you asked also about the test for November. I think if the economy continues to progress broadly in line with expectations, then I think also the overall situation is appropriate for this, then I think we could easily move ahead at the next meeting, or not, depending on whether we feel like that those tests are met.